All right, so we are now live. So webinar is not necessarily my favorite exercise because I don't see you guys. So there is a little widget here telling me that you are already 9 people on the webcast. So welcome. Uh, I hope you are as excited as I am to talk about transactions that involve developer first startups in the first half of 2024. All right, so as I know that you guys have little time, so I want to jump right in. My name is Daniel Jarjura. I want to do a brief introduction about me and about the Volta, and then I will dive right into it. You have a chat box on the right hand of your screen, so you can chat here. Hello, everyone. You can ask questions whenever you want. I will try to answer them during the stream, and I will also leave time for Q&As at the end of the presentation. So, in a nutshell, my name is Daniel. I'm a software engineer by training. I started my career interacting with computers and building software. I had a long operational career managing developers and product managers. I became an entrepreneur, and for the past few years, I was involved in a lot of due diligence and product and engineering restructuring before fundraising or before M&A. And since the beginning of this year, I transitioned into investment banking and joined Avolta as a managing director, focusing on enterprise technology software companies with a focus on developer first because, hey, I used to be a developer, and so I kind of have a soft spot for this market, which I think is also one of the most promising right now in tech. A few words about Avolta. We're a technology investment bank boutique based in Paris, in Europe. The company was founded in 2012, so 12 years ago, with a very strong entrepreneurial DNA. So all the founders of Avolta are entrepreneurs, and all the partners are as well. And Avolta advises founders of technology startups in M&A and fundraising. So we've done a bit more than 200 deals since the company was created. Today, we half of our activity is M&A, and the other half is fundraising, with a European focus. Obviously, with a lot of French companies, but not necessarily. And more than 80% of the transactions that we work on are transnational. So that's why the focus of the report I did is global. So first of all, before diving into the report, I just wanted to touch base on what I mean by developer first. So right now, obviously, every company has become a software company, but not necessarily all software company address the developer market. So developer first companies are companies that sell products to developers or that cater for the needs of developers in building their product. That's why I use the word developer first and not developer led, because some of those companies use product-led growth, developer-led growth as an acquisition strategy, but other companies are enterprise, have an enterprise B2B sales model, but still cater for developers, sometimes have an open source version, and we'll talk about open source today. So the categories that we'll be talking about today really touch on software delivery lifecycle, dev tools, infrastructure, and dev platforms. I also added an AI category, and we'll talk about the categories in a few. But really, what we want to talk about today are companies that are selling products to developers or that have developers in mind when they build their product. Now, let's talk about the transaction. So, Avolta is a data-driven investment bank, and as a data-driven investment bank, we look at data, obviously, and so we basically collected all the fundraising transactions in the first half of 2024 that involve developer-first startups. And what we saw is that we identified 171 transactions for a total of $8.5 billion globally, with an average of 25 transactions per month. Obviously, we had a surge in June because a lot of companies usually wait before the summer to announce their fundraising. Remember, the date that we are using here is not necessarily the date the funds came in, but the date where the companies announce their fundraising. Now, what's really interesting, and I don't have data for 2023 here, but we're definitely in a growth trend. So 2024 was a better year than 2023 in terms of fundraising, even though uh, the environment is a bit more tense than usual in terms of fundraising, as you know. Keep in mind, though, that these numbers also include AI first companies, which is making the whole seem better than it actually is. Now, looking at the types of rounds that we saw in the first half of 2024, over half of the fundraising transactions occurred at the inception stage. So, if you're not familiar with that word, inception, that's something that we're hearing more and more from VCs. So, basically, everything that happens before revenue, including companies that have found product market fit but not necessarily have already revenue, is in the inception phase. So pre-seed and seed um, um, basically gather a lot of the transactions. What does it mean? It means that a lot of investors are now getting interested in the developer first sector, but also there are more actually supply of developer first startups to invest in. That's really interesting. Also, the amounts are quite interesting for seed stage company, especially because a few AI startups raised staggering amounts at seed stage. Now, if you look at the cities where these companies were headquartered, Silicon Valley is still the king. So the vast majority of startups that raised funding in H1 2024 were based in Silicon Valley. Um, you have to note though that some European and Israeli companies usually have their headquarters in the US, but keep most of their staff either in Europe or in Israel. So when the company was headquartered in the US, we counted them as a US based company. So that means that the Silicon Valley number is a bit lower than it is, but don't be fooled. A lot of those companies are actually located in Silicon Valley. Paris, and we didn't do it on purpose, but Paris is actually a surprising second in terms of cities, especially for both developer first startups, but especially AI companies. There is a AI renaissance in Paris with the AI renaissance happening right now, and a lot of companies that could have been headquartered elsewhere are going to Paris to found and develop their companies. So this is something that we're going to watch closely, but this is really exciting because cities like Paris and London are really on the map when it comes to developing developer first startups and attracting the investors' eyes. Now, looking at the who actually raised the fundings in terms of categories. So it's really all about AI. AI first companies, and by AI first, I mainly mean companies that are building foundational models or where AI is like the predominant product. So AI first companies attracted more than 60% of the $8.5 billion that I mentioned earlier. So that's why we're actually seeing a market that is a bit blurred by AI, AI being the tree that's hiding the forest, if you know what I mean. So, but if you look at all the other categories, especially in terms of number of transactions, you realize that AI actually that did not um, uh, were not equivalent to a lot of transactions. So if I go back here, out of the 60.6% of the funds that AI companies attracted, 90% of those funds, so 90% of the $5 billion raised by AI companies, went to just five companies: Anthropic, Cohere, Mistral AI, DeepL, and H, all of which focus on developing foundational AI models. So we're really talking about five companies that attracted more than half of developer first funding in the first half of 2024. Now, looking at the number of transactions, this is more balanced. So number one categories are data management and dev tool. So data management with attracting 21.1%, representing 21.1% of the transactions, and DevTools 17%. When we dive into the transactions themselves, a lot of these companies are building products that are enabling enterprise AI rollout. So this is still very related to AI, especially when it comes to data management. So a lot of those companies are selling products to access data faster, to use data better for training AI models, inference, etc. So this is really about companies building products to help the adoption of AI, previously known as machine learning, rather than companies that are doing something that is completely different. And this really translates looking at the biggest transactions. So for data management, the top five data management transactions were C data with a $350 million Series D. It's a data connectivity company. Aerospike, a bit more than 100 million, which is a distributed NoSQL database. um, Weaviate, then Ocean, and Unstructured. So as you can see here from the top five transactions, we're really about accessing data faster and better data connectivity. Now, looking at the dev tool category, what's interesting is that if we take out Vercel, which is, by the way, a staggering $250 million round, most transactions involve AI-driven code acceleration tools or copilots. By the way, there were several AI code copilots companies that raised funding in the second half of 2024. So not mentioned in this study, but the trend is actually reinforcing. So what we see here with companies like Augment or even Replit, that was not code copilot, but that is making code generation a key feature of their platform, and even Codium that actually raised another round in the second half of 2024 were really about code copilots. And I wrote on LinkedIn about that last week, is that I think that investors are really, really bullish about copilots. Today, it's about code generation because that's like the most obvious use case, but I'm pretty confident that we're going to see more copilots coming soon. DevOps copilots, QA copilots, product management copilots, etc. Now, looking at the AI category, which was the third biggest category in terms of number of transactions. Remember, the biggest category in terms of amount, and the third biggest in terms of number of transactions. So here we see the biggest transactions are really, apart from DeepL, which is a bit different, they're doing translation, but apart from DeepL, all the other companies are building foundational models and raising enormous amounts. Not all of this amount is going to buy NVIDIA GPUs, even though a lot of it is. They're also using that money to hire key personnel. There is a AI talent war going on right now everywhere in the world, and building market share. Uh, a side note on valuation. So there has been a lot of chatter around AI companies valuation. My personal belief, and I'm happy to answer questions related to that, is that AI companies are not overvalued; they're undervalued. So I think that we're still barely understanding the enormous potential of what AI will do on labor replacement, and that unlike other software products, AI is actually not replacing another software with something that's better, cheaper, faster, but is literally replacing labor. And when you replace labor, we're not actually thinking in terms of software market share. We're thinking about in terms of labor market share. So that's why I think the valuations that we're seeing here are at least on point, if not undervalued. Now, going to the DevOps category. So there's a notable trend here towards integrating AI and machine learning technologies within DevOps solutions. So we're seeing more and more ML ops companies enhancing automation and intelligence in operations. So there's a strong interest from investors that we're seeing that for solutions that simplify application deployment and scaling. So one of our opinion here is that we're going to see more and more automation and magic uh, happening on the DevOps side to completely decrease the need for human beings doing DevOps work. So we might actually be already reaching peak DevOps. And in the near future, there will be more and more software automating a lot of the DevOps work so that developers can really focus on building solutions and solving problems rather than thinking about how can I deploy my code into production. Now, a side note about open source. So with 1.5 billion raised, which is 17% of the total raised, including $640 million for open weight AI company Mistral, we're seeing more and more open source companies attracting funding. So I can't hear you, but I know some of you are screaming, seeing that I included Mistral in the open source side. So I know that Mistral is not open source per se. Their code is not open source, but because they are included in the open source AI movement, and a lot of investors are considering them as open source. So I included them here. But even if you take them out, looking at the Versailles round, Zama, of course, Base 10 and Structured, and others, what you can see is that not only open source companies are raising funding, but if you look at the top transactions here, we're not talking about pre-seed and seed. We're talking about Series A and Series Bs. So as the commercial open source ecosystem is maturing, investors are now more comfortable investing in those companies, which means two things. One, that investors are more comfortable and they are more used to commercial open source business models, but also that we have a new breed of founders that are comfortable with uh, allowing freedom of freedom of software and transparency as values with a commercial pursuit and the ability to generate tangible revenue. So I'm very bullish on open source. I think more and more startups will be going through the commercial open source route, leveraging open source for transparency, building a community, and leveraging the community to then build a commercial model that makes sense and is fair. Uh, Looking here at a lot of the AI deals, largest fundraising rounds were AI deals, with most of the top deals being Series D plus rounds. With two companies in the top 10, France emerges as a notable player in the global AI ecosystem. I talked about that earlier. So that's very exciting, being based in Paris, to see all that funding going to basically seed stage companies. And even though there has been some drama around H recently, we're really um, curious to see how this is going to pan out, and if other companies will follow suit and decide that Paris is the best place to build an AI company, even if they're not French. Looking at the top investors, so that's really interesting because the top investor in developer first companies is YC. But Y Combinator is not necessarily the top investor because they're looking at those deals. It's mostly the other way around. A lot of developer first companies see YC as like a credibility mark and the a rite of passage, if you know what I mean. So going to YC has two advantages. One, because YC invested at seed stage in very big developer first companies like GitLab or Golia. So they're seen as a very credible investors for developer first companies, or Docker as well. The other very positive aspect of YC is that when companies go to YC, they also have access to the community of founders, which when you're developer first companies, that's basically a pool of potential customers you can address. So that's why a lot of companies actually uh, um, go to YC, and YC invest massively at the very early stage. Now, YC is the number one by just one deal. So there are other investors like Andreessen, Axel, and Sequoia that are also very active. So that means two things. Three things actually. The first one is that developer first companies have become a topic, a theme for large top tier investors. So it's not like some distant um, industry or ecosystem that they're looking for. They're really invested in it, literally. The second the second point we can learn here is that they are investing at every stages. So from seed stage to Series D plus, which actually is a way that these funds have found to get significant equity in those companies. So they usually invest at seed or Series A, and then they invest at each subsequent rounds to remain a prominent investor. And then the third point that we learned from those transactions is that these investors are investing globally. So they're not just investing in Silicon Valley companies, they're mainly investing in Silicon Valley companies, but they're also investing in companies in Europe. A lot of those firms like Axel and Sequoia even have partners in Europe, mostly in London, and they are looking at the European market, investing at everyone's and looking at developer first company from a global point of view and not just from a regional point of view. Now let's talk about M&A. So we had just 30 developer first M&A transactions that happened in the first half of 2024. So that's a bit less than we expected. And in the investment banking profession, so we kind of anticipated a bit more transactions in 2024 because a lot of public companies have very large amounts of free cash flow. Even though we have some downs in the stock market, they are still trading at very high multiples, very high next 12-month multiples. And now that the interest rates are stabilizing, I'm not following what's happening right now. So there might even be dropping. Yeah, I know the Fed is announcing something today. So with interest rates stabilizing, even dropping, so we anticipated that there would have been more transactions, and that really did not happen. So what we saw is that big companies were very picky, really investing in companies that are that they can leverage to keep gaining market share in the areas where the large enterprises, which are their customers, are investing. And where are they investing? They're investing in AI, they're investing in cybersecurity, and they're investing in data management. So that's why when you look at the top categories, cloud represented 20% of the transactions, data management 16% of the transactions, and software delivery lifecycle applications 16%. So and security 16%. So that means that for a total disclosed amount of $9 billion in M&A transactions, cloud, AI, and data management were the most represented. Um, Looking more specifically at the multiples, the analysis of disclosed transactions reveal two different truths. Some companies were clear winners, like Tableau, Run AI, and DCAI, while others were a bit losers. So basically, what does that mean? One, companies that were able to build a significant technological advantage, one, in categories that are um, that are fueling enterprise IT investments, data, AI, cyber, with proven market fit and growing revenue, usually around above $5 million ARR. So those companies were able to get a very high enterprise value revenue multiple. So, for example, Run AI, Israeli company, was acquired by NVIDIA for $700 million, and their revenue at the time was $30 million. So that's a 23x on their revenue. Uh, DCI, also Israeli company, also acquired by Nvidia, uh, had a 20x multiple on their estimated revenue. So they were acquired for $300 million. And Tableau, which is a bit of an outlier here, that was acquired by more than $1 billion by Databricks. So the disclosed amount at the time was $1 billion, but now I'm hearing things that the amount could be closer to $2 billion. So that's a staggering 300x multiple on a company that was barely making revenue, but that was really very central in the data infrastructure for AI. Now, on the other hand, other companies where we were able to get a public valuation, a public transaction amount, ended up being uh, sold for amounts, for valuations that were lower than their previous round's valuation. And this is also something that we're seeing in the market, not just for developer first companies, is that a lot of companies that raised in 2021, early 2022, where the valuations were the highest, and that were not able to convert uh, this funding into high growth and potentially profitability, and that are now in the process of selling, or because buyers are picky, because we don't have that many transactions, then the valuations are lower than what they had in 2021, early 2022. So if you're in a situation or you know a founder that is in a situation where their growth rate is not as high as expected and they're not profitable yet, going to the market might not be the best of ideas right now, unless they have a very high technological advantage and they have been growing steadily and there is a story to tell. In terms of cities, well, the companies that were acquired were headquartered. Still, we see a concentration in Silicon Valley, where 15 of the 30 transactions that haven't occurred. So the Valley is still very significant in terms of M&A activities. What we're seeing is that a lot of the acquirers were also based in Silicon Valley. So does it mean that when you're a European company, you cannot sell your company to a US-based company? Yes, you can, and we've done it. But it's also it's definitely easier to do when you already have a foot in the US. So I often advise CEOs of European-based companies to travel uh, often to the US to create and maintain relationships there that may translate at some point into an exit. But again, it's not a rule per se, especially if you're an Israeli company, because Tel Aviv is the second most frequent headquarter location, with 5 acquisitions highlighting Israel's reputation as a significant center for um, technology companies and a place on earth where American acquirers look for when they're scouting companies. Now, some American companies that have teams in Europe are also scouting European companies, but we're seeing a lot of American companies looking at US and Israel for acquisitions. Now, another thing that was really, really interesting is that 2/3 of the transactions that occurred were for companies whose last round's estimated valuation was under $100 million, including 13 transactions for valuations under $50 million. So that means that 50% of the companies that were acquired in the first half of 2024 were most probably valued at $50 million or less. I'm saying most probably because we didn't get public transactions values for all the transactions. So that means that a lot of the big public technology companies that could be doing enormous acquisitions don't necessarily do that. They actually are more interested in acquiring teams and technologies with proven product market fit and some ARR. And by some ARR, I mean $5 million, between $5 and $10 million ARR. Because the valuations are still less expensive for them, and it's and they get teams and technologies, especially when those teams are around AI, which is a very, very hard space to attract talent. As I told you earlier, public companies and unicorns represented 2/3 of the acquirers, with prominent tech giants such as IBM, Microsoft, NVIDIA, and Google, and unicorns like OpenAI, which acquired 2 companies, and Airtable, that actively acquired startup. So basically, what we're seeing is that if a company is going to get acquired, it's most probably going to be by a public company or a unicorn. And again, the trend is even more interesting when you see that these big public companies don't necessarily do the big acquisitions. They did. When IBM acquired HashiCorp, which also was a public company, it was a huge acquisition. When Databricks acquired Tabler, it was a huge amount, but still for a small company. I think there were 15 or something like that. So if you were a medium-sized company or even like a scale-up, you have to be aware that big public companies are hunting in the same turf, which makes it even more competitive for scale-ups to build up revenue and teams. Now, I'm at the end of this presentation. Before I open the stage for some questions, I just wanted to share some predictions for the next 6 to 12 months. One, I personally believe that the AI funding will continue as more developers leverage foundational models and even special or small models to create innovative applications. So um, I'm actually quite curious to see even more AI companies popping up. Some of them doing specialized models, some of them doing small models, and competing in different ways with the big model companies like OpenAI, Mistral, Anthropic, and so on, to offer new tools for developers. Especially because I strongly believe that we're only seeing the tip of the iceberg right now. Two, as I said earlier, we're going to see an emergence of copilots. So we'll have DevOps copilots, QA copilots, and if you're a founder, I do think that if it makes sense in your roadmap, that you should be considering integrating a copilot or migrating your product into a copilot, especially if that makes sense and that helps your users become more efficient and take um, problems off their mind. But in any case, copilots will definitely transform software development practices, and I'm pretty sure that we'll be more and more coding in plain English or French or Spanish, rather than in programming languages. So that's another level of abstraction that we're going to see in programming languages, which is like the natural trend of programming from assembly to languages that are actual languages. And then third, um, we do think that the M&A transactions are going to happen. The increase in M&A transactions are going to happen. They were just late with the very probable drops in the interest rates. The fact that the big public companies are still making good money, and that there is a strong, very strong competitive pressure on AI deployments. We definitely think that there will be more and more consolidation in the months to come, and that now is going to be a very interesting time to start talking to companies if you're interested to exit. All right. So I almost was on time. It's 6:37 p.m. CET. Do you have any questions on everything I shared? You can use the chat to ask your questions. Obviously, if you have any questions, you can also reach out to me directly. My email is daniel@avolta.io. I'm happy to both discuss uh, these presentations and the current trends in the market. All right, so get a question. So what's your view on seed round at 20 million plus valuation while most M&A are at less than 50 million? It's a great question. So basically, um, it's data versus storytelling. So companies that are raising at 20 million plus valuation, investors are going to want to make a 10x on that investment. So who's going to get acquired for 200 million or more? Very little companies. Now, do VCs think one company may do that? Yes, one company may do that. So the way VCs do their math is it's power law. So it's probable that one companies are out of 10, 15, 20 investments will get acquired at this valuation and will pay for the whole fund. Now, if you're an investor and you want to be more data driven and manage your risk differently, you could also try to invest in companies that will not raise a Series B. So that will just get a seed stage at 20 million valuation or a Series A, and will continue on a path to get acquired. And whatever the amount, it will you will get your investment back with some interest. So it's really about what's your strategy as an investor. You want to invest in as many companies as possible that can get to 200, 500, $1 billion valuation, and you have to do those rounds. And some stories are very credible, but not everyone will do it. Or if you're an investor and you want to maximize your risk, but also lower risk, lower return, then invest in companies that will not have to raise a Series B and will get acquired at 50 million. So that's still 2.5x the valuation. So I would say some investor would be very happy with 2.5x, but not all of them would be. Any other questions? All right. So I hope you enjoyed this presentation. Since you signed up for this webinar, so you will be receiving recorded version of this presentation as well as the report in PDF format. So feel free to share with people that would be interested. And again, I'm very happy to discuss about the current trends and what's happening right now. By the way, I will be doing a full 2024 report early 2025. So stay tuned for that. And I will most probably do more events around developer first companies, both online and in person. So I was very happy to do this presentation today. I hope you enjoyed it, and I wish you a very good end of day or day. Thank you very much.